then, I think a pivot is basically in the next, I think it will happen in the next quarter.
And when you talk about a pivot, because we all talk about different things in a pivot to you is stopping or starting to reverse?
So for me, it is stopping right now. I'm still really looking for soft landing in the US. I don't see major vulnerabilities. I think the reason the economy is obviously a lot weaker, but not weak, is obviously the rise in real rates and the unprecedented rise in tightness in financial conditions. So, for me, you can basically rebalance that pretty easily. Take the first chart in the email that I sent you. It's called in late 2020, early 2021. It did not take a PhD to know that something was up about inflation. Now, I'm not even looking at the sort of indicators that we both like, leading indicators, because inflation is such, the mother of all lagging indicator that you can very easily forecast it with coincident leading indicator. So on my charts, I actually used, simple retail sales deflated by, core CPI and moved it forward by 15 months. Now, that's exactly the chart that you would have seen in early 2021. I was already calling for reflation since March 2020. But at that time, it was still, in 2020, it was more about speculating about reflation. In early 2021, you were no longer speculating. It was very clear that you were going to get a burst of inflation. Yet, the Fed waited another pretty much 18 months. They started to worry about it a year later, and basically waited for 18 months.
I cannot believe the Fed trade headline inflation numbers or headline economic data when the rest of us can see all of these things so far out. I didn't think inflation would go this far. This is a killer chart, but we kind of know. And we know that it's rolling over, but they just don't do it. It's really weird. I don't know what their PhDs are all worth.
I think they're getting the lags completely wrong. And I think it's quite human, right? When you know something will happen, it's really difficult to understand and put your head around why it's not actually happening. Because at the time, obviously, core inflation was at 1.6%. And they were basically obsessed about basically waiting for realized inflation to pick up after years of disinflation. And I think it's exactly what's happening today. So if you're looking at the second chart, which is actually today's chart, and is called, "Please someone remind Powell macroeconomic models are not broken," you will just have to take into account the long but actually stable lag between activity and inflation. And you can see basically that inflation is coming back to 2% with the same lag as it went up 15%. And I think what markets were really waiting for is the turn, right? The peak. I knew it was going to be either this month or next month. Lucky it was this month because it could have been carnage in between in my recommendations. But
what that chart tells you is the speed of which inflation is going to decline as well. That's a really sharp fall.
And historically, that's always the way inflation is falling. And there's many reasons this happens. In fact, if you're interested, we can talk about the supply-demand model, which I think is fascinating because we all, learned it at school and probably never thought that it would be useful. But I think it's been really useful to me in this sort of macro cycle. And that's the supply-demand chart, which is called "Pandemic Inflation was a textbook response to coincident supply and demand shocks, with the resulting equilibrium price setting on the inelastic part of both curves." So basically what you had is basically a move on both sides on the completely inelastic parts of both curves. And you basically get price equilibrium, which is basically setting on the part of the curve where you will get absolutely no move in production because there's no capacity, and everything will basically make prices explode. Now, the beauty about that chart is when those shocks sort of dissipate, you basically fall back you basically still on the elastic part, and what you should be seeing, and that's what I've been calling really, is what you will see is prices completely collapse, but you will not need much of a drop in production or in fact much of an increase in unemployment, because really it's like purely a price move. And that's what I've been betting on. I don't see any reason anything would be different this time. For me, it's really textbook macro.
Yeah. Also, for me, it's so similar to 1946 and that period afterwards, but that was an even bigger, exactly the same supply and demand shock. All the factories were making ammunition or had closed down in Europe. Everybody comes into the civilian labor force, goes to work, buys stuff. There's nothing to buy, prices explode, go up 20%. And inflation was negative 2 years later and then had a rebound effect.
And I see that as a potential.
Yeah, I do too.
Yeah. I mean, cyclically, I think it's very possible that we see deflation in the next 2 years. And one of my recommendations is actually to short 2-year break-evens. I'm calling for a soft landing, but that doesn't mean that we can't get a much bigger hike, a much bigger shock on inflation. I mean, it's just almost like a natural, right? You basically increase prices when you've got pricing power, and then you lose pricing power. You've got massive inventories, and you're sort of like stuck. And the next thing you do is going to have to cut prices. And I'm not saying we will unwind the price increases that we've seen over COVID, but I don't see why we can't see a year-on-year deflation in 2020.
Yeah, because even if, let's say, oil, let's say, stays at $80, well, by some point next year, oil is negative 50% or 40% year on year. So these things drive the numbers massively. Yeah,
that's the joy of cycles, right? I mean, you don't really have cycles where you don't basically mean revert. Is actually quite rare. And the way we wouldn't be reverting on inflation is if basically the Fed slashes rates, but that's not really on the cards anytime soon.
So let's go to that chart about let's go to that chart. Historically, the Fed always pivoted before a peak in inflation.
Yeah, I mean, I think that's really interesting. Like all you've been seeing, all you see on Twitter since yesterday is like, oh my God, come on, inflation is still at, core inflation is still at, headline is still like above 7 and core inflation is still above 5. I mean, you're not going to see a pivot anytime soon. And that's so completely wrong. And, wrong also historically. If you look at the chart that you just pointed at, you can see that even in Volcker's year, you were always pivoting as the Fed before the peak, because you're basically looking, because it's such a massive lagging indicator, and you're basically looking not only at the leading ones, but obviously the fact that at that point, you probably already seen a rise in unemployment. And so the Fed normally pivots with a very small rise in unemployment, but still like months before the peak in inflation. And that also applies to Volcker's year. So unless Powell is going to be basically much more hawkish than Volcker, in which case he's going to have to spend the whole next year apologizing about your job, after he spent the last year apologizing about your loss of purchasing power, which I don't think is really his goal, then I think a pivot is basically in the next. I think it will happen in the next quarter.
And when you talk about a pivot, because we all talk about different things in a pivot to you is stopping or starting to reverse.
So for me, it is stopping. Right now, I'm still really like looking for soft landing. in the US. I don't see major vulnerabilities. I think the reason the economy is obviously a lot weaker, but not weak, is obviously the rise in real rates and the unprecedented rise in tightness in financial conditions. So, for me, you can basically rebalance that pretty easily. So I'm just looking for now, for like a pause in hikes. I don't think we're going to hike even after yesterday's move. I don't think we're going to hike as much as what's priced in the market. But I prefer to be long equities because I'm not seeing yet the necessary forces to basically start looking for cuts.
Hey there, revolutionaries. To join a community sharing insights like you just watched, head over to realvision.com. There you will get unbiased insights and exclusive access to the very best, brightest, and biggest names in finance. Be a part of our community of lifelong learners. See you there.